Uh, Next, we can see double entry example 1. Okay, example 1, exercise 1. For example, I am doing following the transactions of Roger business during the first month trading is given below, right? Record each transaction in T accounts. T accounts, I will teach you how to do the T accounts. And first of all, read the question very carefully and see how to answer. First, identify the what is the answers, what is their requirement. Okay, following are the transaction of the Roger business during the first month trading is given below. They have given some transactions which took place in Roger's business during the first month period. What they require is record the each transaction in T account. They want us to record it on the T accounts. Okay, so we will open a T account. Okay, this is the first of all we see Roger starts business worth 10,000 as capital. Roger bringing his capital to the business. Okay, if it is bringing the capital inside, in the sense capital always has the capital and equity will have a credit balance. Okay, then open a credit capital account. Okay, capital account. Okay, capital account. Okay, this is the T account. I have put capital account. Now what they are telling is there will be a two accounts. There is a two effects, right? Two accounts going to get affected by this transaction. I mean, Roger starts business with rupees 10,000 as capital. So Roger, what he is going to do is he is bringing 10,000 cash into the business. So what are the accounts going to affect? A cash is coming, then open a cash account for that. Okay, capital account is also because he's bringing the capital to the business. So capital account I have opened, and cash account also I will open. Okay, this is the cash account, right? Cash account. Okay, the cash is the current asset, so it will have always the debit balance. Okay, uh, keep it in your mind. So capital account, when Roger starts business with rupees 10,000 as a capital, then capital account will be credited, right? You will say here cash 10,000. Okay, and the other account which is affected is cash account, cash coming in. Okay, then capital account, right? He is bringing 10,000. Okay, see how it works. And okay, capital is bringing the capital 10,000. So there is a here double entry is completed because this side is debit. Okay, dear, this side is the credit. This side is a debit, dear. This side is the credit. Okay. Normally, left hand side you have a credit entries. On the right side you will have a left hand side you will have a debit entries. On the credit hand side you will have a credit entries. Okay. Left hand side debit, credits, right hand side credits, debit and credits. Okay, so double entry has is completed for the number 1. Okay, we will see. I will number it for you all to 1. Okay, 1. Okay, capital. So have you understood all this? Okay, in T account we will have normally I will draw here and see show you. This side is debit. Okay, debit we will denote it as a debit. This side is credit. Okay. Okay. And we said in first question, Roger starts business with rupees 10,000 as a capital. So capital, he's bringing the capital. So cash is coming. Then cash account we are debiting, and capital account we are crediting, because capital is the equity and capital. Okay, increase in the capital. So capital account is debited, and there's a cash always we disclose the cash under the current assets and current assets. It's coming under the current assets, and there is a increase in the assets. Okay, if there is an increase in the assets, you will have to debit it. Okay, then you say capital and debit it as a 10,000. So I hope you would have understood this first adjustment, and we will go for the second adjustment. Second adjustment, the business buys car for rupees 2,000, right? For you to understand, I am taking the simple amounts and simple questions, okay, simple adjustments at the basic level. Okay, the business buys car for rupees 10,000 cash, 2,000 cash. In this case, what are the accounts going to affect it, or what is the effect of this transaction? Two accounts going to get affected. One is car account. We can open a car or vehicle. Okay, we will say car at the starting point, car account or vehicle account or vehicle. Okay, vehicle account, car account or vehicle account. So normally we used to treat this under the vehicles, but for you to understand, I have mentioned here as car. And what is the other second account is getting affected? That is cash. Okay, this is the cash account going to affect it. So when you purchase a car, when you do the purchasing the car is an asset. So asset will increase. When the asset will increase, what is the entry you will pass? You will pass the debit entry. Then you will say here narration. You will say I will put the transaction for 2,000. Okay. And what is the other account is affected? That is, you are paying by cash account. Here we have the cash account. So cash is what is happening? Cash is decreasing. Okay, when you are paying out the cash, then cash is decreasing. Cash, how do you identify the cash is an asset, not an asset. It is coming under the current asset. Okay, if there is a decrease in asset, you have to pass a credit entry. So you are putting 2000 here. Oh, okay. Now you had to give narrations. Okay. Here you have to give narration. Here you have to give narration. So what is the narration you will give? Opposite account, cash. Car account, you say cash. Okay. For you to understand, I am putting the number 2, cash. Okay, cash. We are paying out cash, 2000. We have purchased cash, car, then this is car or vehicle. Okay, this is the double entry for second adjustment. Okay, understood? And when we come to the third adjustment, they purchased goods for trading, okay, for rupees 1000 cash. Okay, for 1000 rupees they are purchasing the goods. Then what we'll have to do? Purchasing. We have to open another account called purchases. Okay, this is purchase. Okay, here we say dr and cr. Okay, this is purchase. Purchase. Okay, we are opening a new T account for purchases. Why? Because of adjustment number 3. Okay, they buy goods for trading rupees 2000 cash, for 2000 cash. Okay, purchases. What is the entry for the purchases? Purchases means you, for the trading purposes, you are purchasing you are buying some goods for the purpose of reselling. Okay, so if it is a goods, it is an current asset. It is an asset, current asset. Okay, if there, what is happening for this particular adjustment? Goods are coming in, then there is an increase in goods. Okay, if there is an increase in asset, we will pass a debitant entry. Okay, we are purchasing for 1000. Okay, what is the other entry for this? You are purchasing it for cash. Okay, you are purchasing it for cash. That is for 1000. I say correct, because you would have understood. I mean, the cash belongs to the assets. When you do purchase, there will be a cash purchase. There will be a reduction or decrease in cash. If there is a decrease in cash, if there's a decrease in asset, you have to pass a credit entry. Okay, here you have to give narration. Here you will give, I am putting the number 3, cash. Here you will give purchase. Purchases. Okay, now the double entry is completed for adjustment number 3. Now we go for the fourth one. Buy more goods for trading for rupees 1200 on credit from X. Okay, now what you have to do is, this is the credit purchases. Okay, this is the credit purchases. What are the accounts going to get affected? Because in number 4, buy more goods for trading. Goods are coming in. Okay, then assets are going up. Then you had to, what is the purchase account is increased by 1200. Okay, this is number 4 adjustment. Just number 4, 1200. What is the other account is affected? Buy more goods for trading for which 1200 for credit from Mr. X. From Mr. X, he is then creditor, right? Creditor's account. Okay, at the for the time being we can say creditors Mr. X. Okay, creditor Mr. X. Next account we are going to open. This is debit and this is credit. Mr. Who is that person? Mr. Creditor, Mr. X. Okay, creditor. Okay, so creditor in the sense liability. Okay, you have to understand what are the accounts coming under the assets, what are the accounts coming under the liabilities. Liability in the sense we have to give. Oh, okay, assets in the sense we have uh, current assets, and in the sense we they are receivable is the current asset. Okay, later on I will explain to you. Okay, Mr. X is the creditor. Okay, so creditors will increase. Here what happens, creditors will increase means liability is increasing. If the liability is increasing, then you have to pass the entry for the credit. That means 1200 for credit. This is adjustment number 4. Okay. Here you have to give the narration. Here you will give purchase, purchase. Here you will give Mr. X. Okay, Mr. X. Okay, account 1200. That is the completion of number 4 adjustment. Okay, now have you understood all these things, double entries? If you have any queries, let me know. Adjustment number 5 is they pay rent for 400 each. We have to open again an rent account. Okay, here we will open an rent account. Okay, here this is debit and this is credit. Okay, this is called rent. Okay, rent account. What is the rent? Rent is the expenses for the company. The rent is the expenses for the entity. Okay, they pay rent for 400 each. 400 each in the sense only the starting month, first month. So rent is an expenses. So you debit the expense with 400. Expenses always will have a debit entry, and revenue always will have a credit entries. Okay, so number 5 says they pay rent for 400 cash. If it is a cash, next account which is going to get affected is cash. Cash is decreasing, you are paying out, then cash is decreasing. If the cash is decreasing, the asset also decreasing. Okay, if the asset also decreasing, you have to pass the credit entry. Okay, here you will say number 5. Here you say number 5. How much? 400. What is the narration you will give here? You will give cash. Here you will give rent. Rent. Okay, that is the adjustment number 5. Next, you will see adjustment number 6 says they sell half of the goods for 1,600. Half of the goods they sell it for 1,600. Then we have to open another T accounts, sales, for the sales. Okay, this is debit, this is credit. Okay, so this is called as sales account. Sales account. Okay, this is called as sales account. What are the affected account? First of all, you have to identify the what are the accounts get affected. They sell they sell half of the goods for 1,600. Sales, it is a revenue. Sales means revenue. Revenue always have the credit entry. Then you will pass and credit for 1,600. Number 6. This is how. What is the accounts affected here? They sell half of the goods for cash, 1,600, 4,600 cash. Another affecting account is cash. When you sell, when you sell the goods, goods are going out. Okay. When the goods are going out, you are receiving the cash. Cash means cash is coming into the business. If the cash is coming into the business, the corresponding cash level is increasing. If the cash level is increasing means the assets of the entity is increasing. If the assets are increasing, what is the entry? For the increase in asset, you will have to pass debit entry. So you are going to debit cash account by 1,600. Okay, 1,600. Here you will say cash. Here you will say sales. Sales. Okay, that's all. Next one, number 7 adjustment. They sell remaining goods on credit. Okay, what they are doing is they sell remaining goods on credit to Mr. B for 1,600. Hmm? Remaining, remaining. So what is the who is the person to whom we are selling? His account we have to open, right? Mr. B. Okay, here is debit. This is the debit side. This is the credit side. Because this we don't need to write this dr and cr because it is understood. You are starting from the scratch. Because of that basic level, I am writing all of this stuff for you all to understand very easily. Okay, what we said, they sell remaining goods on credit for Mr. B, right? This is Mr. B called debtors. Okay, this is Mr. B. Okay, we call this account as debtors. Okay, debtors. Mr. B, we are selling the remaining goods to Mr. B on credit. Okay, what are the accounts going to get affected? Sales account and Mr. B's account. Mr. Sales account always will increase because revenue is increased by 1,800. This is number 7, 1,800. Right? Goods are going out, but cash is not coming in. Right? Instead of coming cash coming in, we are going to receive this amount from Mr. B after 30 days or something like that. Because we have sold it at the credit price, credit basis. So he is the person who has to give money to us. Means it is receivable. Accounts receivable. If it is accounts receivable, it is coming under the assets, current assets, assets. If there is an increase in assets or current assets, then that has to be debited. Then Mr. B's account is debited with the 1,800. Right? Number 7. What is the corresponding? This is the sales, because why? Sales. This is why Mr. B, debtors. Mr. B, right? Debtors, you can say, because I don't have enough space here to write debtors. So because of that, I have mentioned only the Mr. B. So this is this, and next adjustment is they pay rupees 800 cash on account of the amount payable to Mr. X. Who is Mr. X? Hmm? Who is Mr. X? Mr. X is the creditor, right? Mr. X is the creditor. What we are doing, the Roger paying rupees 800 cash on account. The Roger pays 800 cash on account of the amount payable to Mr. X. So what are the accounts affected? Mr. X account is affected and cash account also getting affected. So when you are paying, creditors are reducing, diminishing. Okay. When creditors are reducing, the liability is reducing. Creditors are liability. So liability is reducing. If it is a liability is reducing, what is the entry we have to pass? We have to pass a debit entry, right? So X account, we will say number 8, 800 rupees. 800. Here we are paying 800. Okay, this is number 8 adjustment number 8. Here of course you have to put the dates of the transaction, but for you to understand we are putting the numbers. Okay, so you can see what is the adjustment cost for the corresponding numbers. Through numbers you can track the double entry. Okay, so what is the corresponding adjustment? Because we are paying to Mr. X. So Mr. X account cash account Mr. X. Okay, very easy, very easy. If you understood the, if you understand the basics, then rest of the things are easy. Okay. Number adjustment number 9 is the receivable rupees 1000 from Mr. B. We have received we have received rupees 1000, received rupees 1000 from B. B is the data. B is the debtors. Debtors are categorized under the assets. Okay, debtors are categorized under the assets because debtors are receivable, because we have sold him on credit basis, we had to receive cash, then that is the asset for us because it is receivable. Then current asset, there is a decrease in increasing the asset, sorry, decrease in the assets, because we are going to receive the cash from him 1000. Okay, then we are putting 1000 receiving. Okay, and what is the next account, because we are receiving the cash from him, cash account assets, asset is cash is increasing, when cash is increasing asset is increasing. So number 9 we say 1000 debit. Okay, 1000 debit. What is the correspondent narration? You will give the correspondent accounts narration. This is the Mr. B, the B, this is the cash. Cash. Okay, they receive. Then number 10th, Roger withdraws rupees 200 from the business. Roger, who is the Roger? He is the owner, right? When the owner is withdrawing his cash, then we can, once we can reduce it for the capital, but rather than going for the capital, we can say yeah, at the beginning table we can deduct it from the capital. Roger's account, capital account is Roger's account. Okay, Roger withdraw rupees 200 from the business. I actually want to open a new account, then only you can understand clearly. Okay, drawings by owner, drawings, this is debit, this is credit. Roger, drawings. Okay, we'll say Roger's account. Okay, drawings means Roger is drawing, he's getting money, means Roger's become a creditor. Okay, then when the creditor is increasing, liability is increasing. When the liability increasing, we have to pass entry, credit entry. Okay, 200 credit entry number 10. This is the number 10. Okay, number 10, Roger's account number 10. And next corresponding double entry will go to the cash account because we are paying from the cash. Okay, here cash is going out of the cash out, going out of the entity, then we are going to credit the cash, sorry, hold on, wait for a minute. Roger withdraws rupees 200. Okay. Rogers means there's a small mistake. Roger become an debtor for us, not the creditor. Okay. Roger is an Roger withdraws rupees 200 from the business in the sense cash is going out means we had to receive from the debt from the Roger. Then Roger become an receivable coming under the receivable is an asset. So we had to put Roger 200 here, right? Number 10, adjustment number 10. Cash is going out because we have given out rupees 200 to Roger. Cash has gone out. Then asset has decreased. Decreased means credit. Asset decreasing means credit. Then we would say 200 here. 200 here. Then what are the corresponding entries? That is Roger's account is cash and cash account Roger. Okay, Roger. This is the T account. Okay, I hope you would have understood the T accounts, and we can go for the small P&L and balance sheet, right? To for you all to understand. Okay, uh, if you understood up to this level, it will be easy for you all to understand the uh, P&L and balance sheet. Here you cannot keep the accounts like this, right? You had to balance it. Okay, balancing in the sense you had to see which side is more, which side is carrying more amount, right? That amount you will put here. Okay, here, here. Okay, here also you will put like this. Okay, we can balance the account. We will balance the account from there. Okay, 10,000. Here we will say 10,000. Okay, balance, here we will say balance carried down, that also 10,000, right? Here balance brought forward, balance brought forward, okay. Here we have the credit balance. Okay, here when we are balancing, here's a great amount, bigger one we have 10,000. Here we will say balance carried down 10,000. Here we had to brought forward to the next month because this is the closing entry of the current month. This is the opening entry for the next month, new month. Okay, this is the opening month. So here car account also we will say 2000, right? Balance carried down, here carried down, balance carried down 2000. Okay, here you will say balance brought forward 2000, right? This is the balancing. This is brought forward to the new month. This is brought forward to the new month. Okay, here also purchases. 2200. Okay, here balance carried down, it is 2200 and 2200. Here brought forward balance brought forward is 2200. Okay, like that. Here also this is a greater amount, so we'll put like here 1200. Here 1200 carried down. Here we have to put the balancing figure. Okay, because here we have debit balance and credit balance. For this credit balance is more than the debit balance, then the difference carried down is 400. 400. Okay, then brought forward 400. Okay, like that. Rent also balance carried down 400. 400. 400. Balance brought forward also 400. Okay, and for the sales, only the credit balance is there. So you'll see 3400 and balance carried down 3400. Here balance brought forward 3400. Sales always will have the credit balance. Okay, and here Mr. Debtors balance, here debit balance is more, so you're balancing the debit balance 1800. Here 1800. Balance carried down is 800. Okay, brought forward, balance brought forward, it's 800. This is the balancing method of the T account. Okay, when you are balancing, you have to see which side is more. That side you have to balance it 1800. At the opposite side, the difference will be the carried down. The difference is 800, then that is become a carried down. For example, here we had Mr. B debtors account, only debit balance is more than the credit balance, right? Then we have balance 1800 and 1800. The difference between is 800. So we put it as a carried down balance 800. Here brought forward is 800. This is for the new month. Okay, this is the end of month balance. Will be the beginning. Okay, then Roger's account drawings. Okay, this is 200. This is also 200. Carried down balance 200. Brought forward balance 200. Okay, then we will come to the major account. Okay, major account here. This is the greater amount, debit balance is greater amount. Okay, so 12,600, right? This is You say 1400, 12,600, right? The difference will be the carried down balance. Have you understood? This is the carried down balance. Okay. The difference will be the carried down balance. Okay. This is for 200, 1000, 1400. Then here we will say 1200, 1600, and I will put another 1000, 3, 4. 4 means 8,000, 8,200. Here Broadford balance is 8,200. Okay, balance is 8,200. If you wish, I will do the profit and loss account and the balance sheet. Okay, this side without complicating there. I will do the profit and loss and balance sheet here. Okay. Otherwise we can conclude it with this, because the question is record the each transaction T account. Only the recording is only they have asked for the recordings only, but I have taught you how to record and how to balance the T accounts and how to transfer it to the um, balance sheet and profit and loss account, right? I think it is not advisable for you all at this stage to do it, but anyway I will do this as an in extra way. Okay, so don't don't need to concentrate here very much, but here you concentrate it. Okay, only this thing, and later on I will show you how to prepare the trial balance and balance sheet. Okay, thank you for watching this video, and I hope you would have understood all the explanation I gave, and I will meet you in next chapter. Thank you very much.